All right, we can go ahead and get started and let people in as they get here. But I'll go ahead and introduce myself. My name is Ronan Friend. I'm a content marketing manager here at NAIFA. Just a couple of housekeeping items before we dive in. Just so everyone knows, today's webinar is being recorded. So if someone isn't able to make it or has to drop out early or just wants to watch it again, the recording will be sent out to everyone who registered in the next couple of days. In the email with that recording, we're also going to include a survey. Would appreciate your feedback so that we know what kind of content you'd like to see in the future. If at any point you have a question, feel free to ask it in the chat. I'll be monitoring that, and Joe will be stopping periodically to make sure that to answer any questions that anyone has. If you enjoy today's webinar and want similar content, you can always watch our past webinars on demand and access our financial security blog posts and our resources at financialsecurity.org. So without further ado, I will turn over the virtual floor to Joe, and he can tell you a little bit more about what we'll be talking about today.
Great. Thank you so much. And thank you everyone for joining us this evening. This evening, the program is Financial Wellness 101, brought to you and developed by the National Association of Insurance and Financial Advisors. Let me tell you a little bit about myself. I am a veteran financial advisor. I've been working in the financial services profession for 39 years. And although it just seems like a minute, as some would say, and what I have learned is that the most important element of what I do is to empower others to learn how to plan successfully for their future. And if you can take away just one idea, one concept that can help empower yourself to make your life a little bit more successful, then I would say that we had a really good time. Financial wellness is more than understanding how to budget and manage your money. It's about having security and stability planning for the short term and long term. It means setting financial priorities and thinking about how you want your future self to live. Today is going to be a grand overview of financial wellness, a 30,000-foot view. I'll go over the ways in which you can set up and divide your money, the ways you can protect your money, and ways you can set up yourself for a bright future. These are the building blocks that will help you become more financially secure, and it's important to know no two people have the same exact priorities. This one-hour crash course will award you the tools in which you can craft your best, most financially sound plan for yourself and your family. So let's get started. And well, as was already mentioned, this presentation is brought to you by financialsecurity.org and NAIFA. The future depends on what you do today. I know in my past life, I tended to procrastinate. That's a dirty word. Procrastination is basically failing to plan. And when you fail to plan, you are planning to fail. So let's talk about cash flow. That is the most important and the beginning part of any financial strategy. So what is cash flow? Cash flow starts with basic budgeting, your checking and savings accounts, making the most of a budget, credit and debit. Now, budgeting is kind of a funny topic. Some people don't understand how to budget, and some people choose not to. So you have to ask yourself, which one are you? Now, everyone knows what a checking and savings account is. Basic budgeting is really knowing what your revenues are and what your expenses are. And the best way to know how to do that is by looking at a budget. Most people have a really easy time to figure out what their income is, what their revenue is, because if they have a job, they know what their paycheck looks like. But the expenses, that can get kind of tricky. Many of us spend a lot of money on things you don't even know you're spending on. Think about Amazon or other online services that we buy things from. With a couple of clicks, you have bought something. Sometimes it's being delivered before you know you bought it. And that's our modern world. You need to be very, very careful on what you're spending money on and if it's really important to you. Otherwise, you can build up credit and debt beyond your capacity to pay for it. And that can be the beginning of a downward spiral that you really don't want to be involved with. Now, we're also going to talk about protection. Protection comes in different formats in today's society. It comes in the form of protecting yourself against fraud, identity theft, and various types of insurance to protect against different types of perils to your property or to yourself. Insurance is one of the most common ways millions of Americans protect their assets through insurance. You can get insurance for anything: your car, your life, plane tickets, a TV, even Beyonce concert tickets. Insurance means a company or organization guaranteeing you some sort of compensation for damage or loss of a product if you pay them a premium to begin with. It can really be a cushion for when disaster strikes, when you least expect it. Let's dive in and take a look at some examples of important insurance each of you should have. Car insurance. Well, if you drive a car, in most states, if not all states, it's a legal requirement that you have car insurance. So I think that at least some of you in the room have experienced this situation. It can be a very rattling situation dealing with the immediate reality of car damage while you're thinking about everything else that comes next. That's why car insurance is all the more important. According to the National Highway Safety Administration, 6 million car accidents happen each year. So it's important to be protected. It is also mandatory to have when you register your vehicle. If you put money toward your car insurance early, you can save later if and when an accident affects you or your loved ones. The money can go towards physical repairs of the car or even supplement health insurance, which can cover any bodily injuries. To find the best coverage, you can meet with advisors at numerous insurance providers who are big players in car insurance and who can provide you with a quote. Now remember, car insurance is not all about protecting the property. Sometimes it's protecting yourself about being sued if you're at fault for causing the car accident. So you need to protect yourself against the liability as well. Health insurance. Well, most of us have a good idea what health insurance does. Health insurance works in a similar way as car insurance by avoiding high damage costs. Well, health insurance protects you from your medical care costs. You buy a plan or policy that outlines exactly what is covered. When you go to your primary care physician or if you end up in a hospital, having health insurance can significantly decrease the cost of insurance, hospital stays, and help bring down the price of prescription drugs as well. It's important to do some research on the doctors in your area to see what insurance companies they accept at their practices, because each practice is different and different insurance companies will have different types of coverage. Many employees provide health insurance as part of their employment plan, which can include coverage for dental, vision, etc. Also, with the Affordable Care Act, you can go on to healthcare.gov and enroll in a healthcare program. This website also provides you with options to get healthcare covered through the Marketplace, Medicaid, CHIP, or Children's Health Insurance Program. The government-sponsored online mall is fabulous for comparing and enrolling in various health insurance plans. You need to be sensitive to the open enrollment periods, and remember there is no medical underwriting. Now we're going to talk about some different types of health insurance plans. HMOs, or health maintenance organizations, are very, very common because they tend to be richer in benefit. That would mean they would have lower out-of-pocket expenses and more coverage for each individual. However, they do have limitations. They're limited only to contracted providers. So if you go to a physician that is not in that plan, it will not be covered unless it's an emergency. And it's not an emergency by your definition, it's an emergency by the insurance company's definition. Now, they do have outpatient providers, hospitals, and medications. You will have copays, deductibles, and many times you will need to get your care pre-authorized. Another form of health insurance is a PPO. This program, it operates in a similar fashion to HMOs, except you typically get a richer benefit structure with contracted providers, contrasted with the ability to see providers that are not contracted with the plan. However, you will be paying more out of pocket and copays if you go to non-contracted providers. The next type of care would be for individuals who are age 65 or older, or on Medicare disability, Social Security disability, which will enable you to qualify for Medicare. This is base of government health insurance, and like I said, primarily for age 65 and older, and it may be complemented with a Medicare supplement or Medicare Advantage plan. It is important to note that Medicare by itself has gaps in it that really should be complemented with these other forms of insurance. Now, we're going to transition into life insurance. Life insurance is another added security measure to protect you and your families. Life insurance helps pay money to your family after you die and can be used to cover a number of things, from living expenses, loans, and mortgage payments. Best of all, the proceeds of life insurance policy are never subject to income taxes. It is always recommended, if you have somebody that financially relies on you, you should have a life insurance policy. They have helped families recover when the toughest of losses impact their lives. You can invest in two types of life insurance: permanent and term life insurance. Permanent life insurance provides lifelong protection by providing the premiums without taking loans or late payments. The full amount is paid out. Permanent life insurance covers an entire lifetime and accumulates cash value over long periods of time. Term life insurance is designated on a temporary basis and is typically the most affordable life insurance. This provides you protection for a specific duration of time and is effective if you die during that time period. Sometimes combining both permanent and term life policies is best for you and your family. People then ask, how much should they put towards their life insurance? It always depends on your specific financial situation and your future goals. You should take stock of what essential expenses your family deals with on a regular basis and what it could deal with in the future. The best way to really pinpoint how much should you put towards your life insurance plan is a life insurance calculator, or seek out an insurance professional. When you're dealing with life insurance, the other aspect you should be thinking about is, who is your beneficiary? And if you have life insurance, check out your beneficiary designations. It's a really important element of that type of insurance program. Other types of insurance are renter's insurance, disability income, and travel. Renter's insurance helps protect assets and belongings if you are renting your house or apartment. Disability insurance is compensation given to you if you suddenly become disabled and unable to function normally like before. Travel insurance is money you can get back if extenuating circumstances cause your travel plans to change or get canceled. There are so many different types of insurance, and you may not need all of them, but it's important to get the essentials which affect your life most. Nobody should be left unprotected in the event that disaster strikes. Insurance catches you if you fall. Now, let's go into savings and investments. Let's talk about setting goals, prioritizing your future, compound interest, college savings. Saving for education. Saving for education can be a very, very intimidating task. With college tuition prices going up every year, it can seem challenging to know just how you will be able to afford it when it comes time for your children or your grandchildren to attend college. One of the most common ways to start saving is through a 529 plan. This can take the form of a prepaid tuition or a college savings plan. There are many outlets for saving and establishing a 529 plan, and you should definitely research these options if you're in a situation where you will need to be planning for someone to attend higher education in the future. Now, college savings plans include programs for kindergarten through 12th grade, college and grad school. Earnings grow tax deferred, withdrawals are tax free, and they're not just for children. The college savings plan is a plan that you save annually, and it can be used toward tuition, college expenses, room and board, books and supplies. These accounts are not limited to certain institutions or specific states. However, you might miss out on specific state incentives. Annual minimums and maximums vary depending on the account, and if they don't lock in tuition prices for specific institutions. Now, the other type of program is called prepaid tuition. Prepaid tuition plans lay out a plan where you put money into an account now that locks in tuition prices today and alleviates the cost of it down the road. Most of these plans are in tandem with a specific state. For example, if you live in Texas and you know you want your child to stay in state, then a prepaid tuition account would be beneficial so you could start saving now when tuition costs are lower. The price of the investment contract is predetermined when you open the account and takes into account the age of your child along with the project rate of return as well. So let's start transitioning into saving for retirement. Saving for retirement can take a few different forms, but it requires opening up certain types of accounts. So for example, you can open up an individual retirement account or a 401k. Accounts are different ways that you can set up putting money away before you pay, before now, and so you can save more later. Now, an IRA comes in two different forms. It comes in a pre-tax form and an after-tax form. The after-tax form is referred to as a Roth IRA. Now, the IRA funds are accounts that you and your spouse can open up. There are major tax incentives for this because it is free from the clutches of the US government. That's a fancy way of saying it's pre-tax. The money you contribute can grow with interest and capital gains to maximize your savings. There are different types of IRAs. Like I mentioned, the most common are traditional and Roth IRA, which requires you make up a certain amount of income to open up. If you are under age 50, you are able to contribute up to $6,500 in 2023. Each year, the maximum amount that you can contribute may be adjusted. If you are age 50 or older, you are able to put in up to $6,500. Depending on the type of IRA you open up, they might need a required age of withdrawal where you need to start taking the distribution out of that account. If you need to start withdrawing too early, for example, at age 59, you might be hit with a 10% penalty on what you withdraw. 401k plans are savings plans offered by employers. This plan allows your employer to take a portion out of your pre-taxed income and put it into a savings account, making a small contribution and adding by 1% each year. That will make it heartily noticeable and impact in your take-home pay and soften your tax bill as well. Similar to an IRA, you don't want to take out this type of account too early, that's before age 59 and a half, or risk facing a 10% penalty. Additionally, you won't face any taxes on this income by the government while you save it. Once you start withdrawing from this account, then you will have to pay taxes on it. Now, moving into the retirement planning section, we're also going to be talking about Social Security, planning for retirement and lifestyle, home plans for living, laying out an IRA, and pensions. Social Security. I'm sure many of you are familiar with the concept of Social Security, but you may not know exactly all it does. Social Security is the concept of the American labor force taking a piece of their paycheck out now and giving it to the government, saving it and getting it back once you're in retirement. You can also collect your Social Security if you've incurred a disability as well. To collect your Social Security benefits, you have to build up at least 40 credits. That is, one credit is equivalent to $1,300 in income. And you can save up to 4 credits per year once you've turned age 62 years old and you're able to collect your benefits. The amount of Social Security you receive will depend on how much money you saved while you were in the workforce and how early you started saving. The earlier you start saving, the better. Social Security benefits would only cover a fraction of your pre-retirement income, which is why it's so important to put money into savings concurrently. Now, let's talk a little bit more about Social Security. Now, it is true that when you turn age 62, you may start collecting Social Security benefits. However, if you defer from collecting Social Security benefits until your full retirement age, or commonly referred to as your FRA, your full retirement age, you will earn more benefit. And if you wait from your full retirement age until age 70, you will earn an additional 8% per year, plus any cost of living adjustments. So you have to think about where you can go in today's world and get a guaranteed return of 8% per year on an investment. It's really hard to do. So this is something, an area that is very much individualized, and you need to determine what is appropriate for you as an individual. There are other elements of Social Security that are really kind of cool. So for example, if you are divorced, then you may be able to collect on your ex-spouse's Social Security record. You can collect up to 50% of your ex-spouse's Social Security benefit if you meet certain criteria. If you are married, you can collect up to 50% of your spouse's retirement benefit, your Social Security benefit, as it may apply to you. It also can help deceased or widowers, and it also can provide benefits for children up to a certain age. So the Social Security system is a really phenomenal program, and it is a very, very worthwhile program, but it does not solve all your problems. It can provide a good foundation for retirement income, but you absolutely are encouraged to save on your own to make sure that you can continue your lifestyle that you would like. Now, we're going to talk about one of the on top of an IRA and 401k account, you might also create a pension plan depending upon where you work. Pensions are a defined payout amount you are guaranteed when you retire and can be distributed at once or in monthly portions. Luckily, with this plan, it requires very little planning. The way you get the money, however, is if you're fully vested in the company at this point, which can take upwards of 5 years. You normally start receiving pensions once you're at age 65 or at retirement age. Now, this area gets a little tricky because for the most part, the only type of programs like this, which are referred to as defined benefit plans or traditional pensions, are for public service workers, teachers, firefighters, police officers, government workers in general. 80% of Americans are not eligible for a defined benefit plan because it's employer sponsored, and most employers do not offer this kind of benefit because it is very expensive. It's been phased out for the most part in favor of programs like 401ks. So you need to check with your employer to determine what kind of programs you are eligible for. And if you're self-employed, you can create your own program. In addition to that, you can create your own pension program through different types of investment and insurance products, but you need to take charge of your own financial awareness. Now we can talk about home equity. You will also need to think about your home when planning out your retirement. Your home can either be a valuable asset or something to alleviate financial stress once you've decided to retire. If you are a homeowner, your equity can be tax-free for up to $500,000 provided it passes certain financial tests. You can also choose to downsize from your current home and invest when you make it from providing a little more change in your retirement fund and alleviating the upkeep of a larger place. Moving into smaller places can be more financially stable. However, with a larger home, you have more versatility and value to explore different options. Now, with home equity, you also need to consider there are other options like reverse mortgages and also the overall maintenance of the property. Sometimes downsizing doesn't really work. It's very much an individual situation. And again, everything through this presentation is designed for you to evaluate as an individual. Well, let's talk a little bit about legacy. We'll briefly touch on how estate planning works, which includes how you can structure a will and a trust for your family after you pass away. Long-term care, estate planning, structuring a will, and trust. All of the elements are really, really important. Estate planning is the overall process of planning out your assets after you are gone. There are many forms this can take, two of which are through wills and trusts. Along with naming your beneficiaries, you will add in various healthcare incentives, protections of property, avoid estate taxes, which 99% of people won't owe federal estate tax under current law. Estate planning is predominantly about having all your documents in order that protect your family, your business, and any post-mortem expenses your beneficiaries might face. A will is a legal document containing information and instructions that lay out what should be done with your money, property, and possessions after one's death. Creating a will streamlines the process for your family and friends when sorting out your belongings after you die. Without a will, everything you own will be shared out in a way deemed fit by the law, by the state law. However, with a will, you can ensure your family or other beneficiaries are protected after you're gone. This document lays out who should be handling your money and assets, whether that be friends, family, or even charities. It is important to thoroughly evaluate your assets and their worth, then move on to determine how it is to be distributed. It is super important to make sure that you have estate planning documents in order and in place, because if you don't make decisions, the state will make them for you. Other documents include trusts, but I want to talk about powers of attorney, living wills, and healthcare proxies. They're just as important as the will itself. And keep in mind that the will is a document that only comes into play after you pass, but a power of attorney, a healthcare proxy, and a living will are documents that come into play while you are alive. So don't put off exploring the creation of these documents. Don't procrastinate. It's really important, especially if you have children. Because consider, if you have children and you don't have any legal document stating who would become their guardians in the event that you, the parent or parents, pass on, they could end up in foster care. They could end up being bounced from one family member or another, or they could be pawns in a family legal dispute, especially when there is finances like life insurance or property involved. It's a really important issue to explore. A trust document is a more sophisticated document that outlines the steps that you want people to adhere to regarding your property for your beneficiaries. While your will is a document that outlines how you want your affairs and assets handled, a trust is an agreement where you can give another party control to handle your assets for the well-being of your beneficiaries. Wills can also be used to create different types of trusts, but not vice versa. In short, trusts are another version of estate planning that can provide your beneficiaries extra security in any event. There are many different types of trust documents. Trusts can live beyond a person's mortality. Trust can be very, very important if you are trying to avoid probate. Probate is the process, the legal process of distributing your assets once you pass. It's also important to have beneficiaries on as many financial products as you can, whether that be a bank account, a savings account, a certificate of deposit, a life insurance product like an annuity or life insurance, mutual funds, your IRAs, as many financial products as possible. Make certain that they have some type of beneficiary designation so that those funds can avoid probate and can pass to the individuals that you choose sooner and without legal recourse. Now, let's take a few moments and talk about options that you may elect to become involved in the financial services profession. Our profession is, I look at it more like a universe because there are so many different choices within the industry. And in fact, most people who get involved in the financial services profession come in as a second profession. They did a change. They started out doing something else, and they decided to change because they learned about the potential for helping others, greater time flexibility, and the ability to make a decent living. So let's explore a little bit more about these options. Insurance agent. Well, there are different types of insurance agents. We talked earlier about all the different types of insurance products that are out there, the different types of protection. Well, property and casualty agents deal with insurance, renter's insurance, homeowner's insurance, different types of insurance to do with things. Life insurance agents deal with life insurance products. Clearly, life insurance, but also annuities. Annuities are a savings vehicle, which is an insurance product that has very, very special features that allow for deferring taxation while the funds are in the account. And you could also be a health insurance agent. So that means that you would be talking to people about health insurance. Could be underage health insurance, or it could be overage or senior health insurance like Medicare supplements or Advantage plans. Now, you also have the capacity to get licensed so that you could talk to people about all forms of insurance, property and casualty, life insurance products, and health insurance. This type of agent would be called a multi-line agent. Now, the cool thing about getting involved with financial services is not only are there so many different types of options, but also you might work for a company, a large company, a small company, or yourself. You might be able to work remotely. You might be in a hybrid situation where you can work part-time remotely and part-time in an office environment. There is so much flexibility involved with the financial services profession that it really is a good idea to consider the options available to you. Now, if you want to get more involved on the investment side of the financial professional world, you could become a financial advisor. A financial advisor is an individual who has additional licensing. Oh, I think I did forget to mention, if you choose to become an insurance agent, you do have to go through some licensing and education requirements. You do need a state license, and before that you can get involved in the sales and service of insurance products. Now, as a financial advisor, you would need to have a securities registration. And you can either go in one route, which would be through a broker-dealer. And a broker-dealer is a company that has rights to work with FINRA. FINRA is a self-regulatory body, and financial advisors have the option of working through a broker-dealer. And I equate that kind of like a country club membership. So the broker-dealer has the country club membership, but because, and then you associate yourself with the broker-dealer, so that means you can go to the country club. And FINRA is basically the country club. So that's one way I look at that. Another way that you can become a financial advisor is by becoming a registered investment advisor. And that's a different form of securities registrations. And you could you can go through the Securities and Exchange Commission, which is a different governmental body regulating financial products, variable financial products. Now, there's also financial planner. Financial planners has a slightly different connotation. You could be a fee-only financial planner, meaning that you're not marketing insurance, you're not marketing a particular product, you don't earn a commission. You work with people who strictly want you to develop a financial plan, and they pay you a fee for that service. Once you develop that plan, they then have to go to an insurance agent or a financial advisor in order to actually execute the plan. Now, there are fee-based financial planners that can earn commissions and fees. So it gets kind of interesting and can be a little bit complicated, but there are all kinds of opportunities available. Now, as I mentioned before, there's a lot of flexibility on where you could work. You could work with an insurance agency, and insurance agencies come in different sizes. There are small insurance agencies with 2, 3, 5, 10 people. And then, or you could be involved with an insurance agency that could be hundreds of people. Tremendous opportunities. You could be working with an insurance company that owns a broker-dealer. And remember that broker-dealer has membership to the country club. Now, you could be working as an employee of that insurance company, or you could be working with an independent broker-dealer. An independent broker-dealer means that you have the capability of marketing products away from the broker-dealer. So you could be basically self-employed, having a relationship with the broker-dealer. You can be helping people acquire and service variable products like mutual funds, maybe stocks and bonds, as well as insurance products, variable annuities, fixed annuities, and all the other different types of insurance products. You have that capacity. There are also wirehouses, large houses, and you've heard of them. Merrill Lynch is a good example. And what about banks? Banks are a big part of the financial services profession. Not only do they offer traditional checking accounts and savings accounts and certificates of deposit, but they have a separate arm that also offer securities products and insurance products. So there's really a lot of choices about where you can get involved in the financial services profession. Now, what are the benefits of a career in financial security or financial services profession? Well, I can tell you that I got into the financial services profession nearly 4 decades ago because honestly, I needed to make a living. But that's not why I stayed in the business. I stayed in the business because I really enjoy helping people and empowering people to learn how to build their own successful financial futures and protect future generations down the line. And that's exactly what I've been doing for nearly 4 decades. If you're interested, you too could get involved with a profession that helps others, and you can help yourself at the same time. And I can tell you that this profession has enabled me to meet people that I wouldn't normally meet by belonging to a professional association like NAIFA. It enables me to serve others and the community. You can be involved and you can grow. You can grow as a person. You can get beyond just the pure need to make a living and pay your rent and put food on the table. Growing as a person, elevating your lifestyle, that's an important part of this business, of this profession. Helping others succeed is important. Granted, it can be lucrative, and it can be as lucrative as you want. You can set your own bar. You can take control. You are empowered. You also, even if you're working for a large insurance company, if you meet their minimum criteria, you will have some flexibility, or if you choose to run your own business. Personally, I've been self-employed for nearly 30 years, and I love the flexibility of running my own practice. You too could be in this position. It's really in your hands. If there are any questions, I'd be happy to entertain them. If not, I thank you for joining the presentation this evening, and I hope everyone has gotten at least one successful idea from the presentation.
All right. Thank you, Joe. I was monitoring the chat. It looks like we don't have any questions right now, but if anybody does have any questions, you're welcome to email us. Again, I know a couple people came in after we started, but we are going to send out an email after the presentation. It will include a link for the recorded version in case you want to share it with friends, family, loved ones. And there will also be a survey in there where you can provide any feedback about what you'd like to see in the future. So that is all we have for today. Thank you so much, Joe. We really appreciate your insights there, and I hope everybody has a great evening.
Thank you.